everybody, and welcome back to another market update with the team from Trading and Investing for You.com. And once again, just before we start, just have to make it clear that no investment objectives or financial situations of the viewer were taken into account when we made this, so it's just for general advice only. So let's get into it. Today I want to have a quick look at the Federal Reserve meeting results, because we got those minutes back from the meeting yesterday. I want to have a quick look at that. I also want to have a look at the effects that had on the US dollar. Before we get into it, once again, if you're watching this on YouTube, we have a few different links here, some free education giveaways, the subscription of course, and the blog post where we're going to put an in-depth article on what we're talking about right here. So when you click over to the blog, you have the blog post right there. We have our free video and education there with an outstanding 3-step system to finding amazing entry points in the market by our professional trader John Howe, and also our Cash Flow Mastery Summit just up there. So that's 2 days packed full of cash flow strategies to help everybody out. Any money that we do make is going to our favorite charity. A very, very important event. So please do take a bit of time and have a look at that. Let's get into it now. The Fed and the US dollar. So, what happened with stocks last night? It's probably not much of a secret, but we did see a bit more of a move to the downside. This has continued over the last few days, and it's basically a result of the Federal Reserve meeting minutes that came out. I think by the end of it, the Dow and the Nasdaq finished around 1/3 to 0.5% lower. The S&P remained relatively flat. But unfortunately, the Federal Reserve meeting minutes did not give a clear indication to the investors of what they were thinking and what they were going to do. It was pretty non-committal, nonchalant, as it always is, and investors reacted accordingly. And this even happened despite some somewhat positive news that Spain was moving in the right direction with its bailout. Spain's borrowing costs have started to come down little by little. They're still very high, but they are coming down. Spain has introduced some new sales tax hikes as well as spending cuts, trying to slash around $80 billion from its budget over the next 2.5 years. This is a move in the right direction for pleasing the creditors, I guess, but I don't know what it's going to do for the country in the long run. I mean, I don't understand how slashing growth prospects for a country is going to help it at all over the next 5 to 10 years. How's it going to grow if the prospects for growth are slashed? Anyway, we'll just have to see what happens to them. But despite even that small bout of positivity, I guess, for the Euro crisis, it didn't outweigh the Fed minutes, unfortunately. So what is the Fed doing anyway? Well, basically they came out and basically gave no real plans and no real indication of what they're going to do. Very non-committal. They basically pointed the finger back to Congress and they said that if the US government essentially failed to stop the upcoming tax hikes and the spending cuts, then the US economy could continue to struggle into the future, particularly given Europe's debt crisis and the slowdown in China. That was it. So they didn't say they were going to start printing again. They didn't have any more stimulus bouts coming up in the future. They did say they're going to intervene if job market, deteriorates further. But they've been saying that for a while now. Nothing's happened. So in the end, it was a pretty non-committal response from the Fed, and investors obviously were not happy with it. So how did the Treasury or how did the U.S. government react to what the Fed said? Well, they did similar to what they've done in the past. They announced that they were going to continue Treasury buying programs till the end of this year. The purpose of these programs basically is to keep borrowing costs low, therefore hopefully leading investors out of bonds. Everyone flocks to bonds. They consider them to be a safe haven. And I guess the Treasury is thinking that if they can get out of the bonds, they will go into other asset classes and therefore stimulate the economy a little bit. Other asset classes, being i.e. stocks, things like that. So what actually happened? What was the result? Well, the result was that the US dollar went up, and the euro, which we thought couldn't go any lower, once again got caned. I think it's now down to about $1.22 to the US dollar. So, was the ploy successful by the US government? It doesn't look like it. It seems like The result was a big rush back to US dollar, back to that safe haven currency. We certainly didn't see any more money going into stocks, that was for sure. So, unfortunately, it looks like to me over the short term we're going to have a bit more of a move to the downside. Investors are just not getting the news that they want from economic data that's been coming out, as well as from the Fed and indications of what they're going to do for the future. So unfortunately, I think for the short term, things are going to continue in a bit of a downward trend. Things might pick up if we get some very good earnings reports coming out from the big boys, but I don't think that's going to make much of an overall difference. So that's it for today, guys. Thanks for listening. And once again, I just want to point out our free education that you can find here on this YouTube link. Please do take a look at that. Please do take a look at our blog again. And hopefully I'll be speaking to you again tomorrow.